quick, let me give you a tip on Udemy. It's a big online learning platform with video courses and thousands of topics from
Hunger robs children of their childhood, and we're fed up. Your donation can help support.
What are you doing? Here we go. Have they taken that liquidation zone yet? Wait, 4, 3, come on. They're going to hit that liquidity, I think. They're going to go for that liquidity. Come on, get some precision right there, Tino. Here we go. We're so close to that liquidity and they've yet to take it. How many orders of Bitcoin? 2,060 Bitcoin orders absorbed inside of this zone right here. Yet we've also got 2,045 coming in right now. Let me just expand the chart out. This is very far. Oh, man, I'm excited. Ladies and gentlemen, how excited are you for this information to come out? This is going to make or break the marketplace. Blue vector candle coming in on the 15-minute time frame. Deviation away from the 50 EMA. Everything. Listen, if you are in profits, please, please consider paying yourselves. And even if price does continue to go to the upside, do not begrudge the fact that you took money from the marketplace, because at any moment they can switch it. Remember, they can say one thing which will switch everything. And I hope that they continue to move higher so that everyone can have a smile on their face. Santa's come too soon, ladies and gentlemen. It's not the last 5 days of the year. What's going on? This is what we anticipate. It's always going to be the case. Now, if you manage to exploit this, happy days. But please consider taking profits. I'm looking at some orders. Look at that. Look at how it's changing. Look at the order book. It's getting a little bit aggressive right here. You want to be focusing on red bubbles right here because they're selling at the highest point. Here we go. We got some movement. Here we go. Coming down pretty strong. Bitcoin. No, Bitcoin. Look at that. Terrible. This is why I always say to you, pay yourselves, ladies and gentlemen. Please do not be taken by surprise. Please. And that's not even, look, it's not even FOMC, guys. It's not even come out yet. We still got 2 more minutes. Look at the trickery of Mr. Market Maker. Vector candle recovery right there. That's the shocking truth about this game. You want to play with fire. Do not get burnt. That's the truth. Pay yourselves. I hope you paid yourselves, man. That really depresses me. I do not want to hear about anybody getting liquidated. Euro hasn't moved just yet, but Bitcoin's making the breach. Bitcoin's making the move. I hope that this is going to be the case. I hope that they actually move up. Looking, this is on the 4-hour time frame over here, ladies and gentlemen, so just keep an eye out on this bad boy. Where is price? Price is stalling at the 18,257. Man, please tell me you guys paid yourselves. Please tell me you paid yourself. Look at this distortion. Look at all these orders coming in. 18,510. There's 2,064 Bitcoin in and around that point. They have just swiped the marketplace, guys. And this is what I'm saying about leverage trading. They don't care about our opinion of whether Bitcoin should go to 100K, a million, 500,000. They don't care. They care about where's your commitment. Now, if I'm shouting at you, I'm just very passionate about what I do, so please forgive me. If you are new to the channel, I apologize. 162 orders, 236. That is big. There's a lot of selling happening right now. Vector candle recovery, wick recovery. Here we go, 7 p.m., ladies and gentlemen. Here's the moment of truth. Oh, no, don't do it. No, don't do it, Bitcoin. Don't do it. Oh, here we go. Coming back up. Look, be careful with this zone. The liquidity's there. 18,400. Can they make it? Euro, what's it doing? Euro takes the nosedive. Dixie, where's Dixie? Where's Dixie? Where's the yields? The bonds. Bonds have gapped down. Bonds have gapped down. That's not good. They've come back down into that big green vector candle. Oh, my days. The yield's shooting up, ladies and gentlemen. Volatility index is coming in higher. This is where you... Oh, I really want to say it, but I can't. NASDAQ is coming down to close that gap in the chart, ladies and gentlemen. Be careful with Bitcoin down 2% for the day. It's given back most of its gains and come back up. It's a very treacherous time, guys, so please be careful. The order book right there, look at this. The book map is going absolutely mad. Is it ignition algo? Please tell me. Please tell me. Close to the VWAP right there. So this is the only point of support which we would engage the idea that traders will step in and start supporting the longs at coming in and giving us the commitment. Has the market maker shaken out all the guys who just went long? Sad days. Sad days. Sad days. Where's the pool? Look at this. They've come back down to the selling point. Look at that. We just mentioned that, ladies and gentlemen. They were selling on the way up. And look, it's all red bubbles right there. They're selling. Damn. As long as Bitcoin can maintain this stance right here, and you know what the crazy thing is, guys, we haven't actually gone into the press conference. Do you understand what the problem is? We haven't even gone into the press conference. How many of you paid yourselves? How many of you paid yourselves? Did you take money from this game? Why do you 417 orders of Bitcoin? Look at that, dumping this bad boy, and look what's going on here. Bitcoin is delayed. It's not actually moving. Look at the gaps and the jumps in price. 1, 2, 3, 116 down to 100, back up. This is a treacherous time, guys. Look at this. They are eating the liquidity coming down to test the intention of traders stepping in, going in long. Look, they're eating it. 18,000 has been taken. Look Look at the divergence, not divergences. Look at the arbitrage right there. Bitcoin's at 17.98 now. Bitcoin should move very shortly. TradingView is lagging out. BookMap is going crazy. 245. Look, they're eating that liquidity. What is going on? Bitcoin should be at 17.960, guys. Why is it not moving? Oh my days. Vector candle, principle or what? Violet vector. This is why we wear a purple shirt, ladies and gentlemen. Welcome to the Traders Reality Show. This is one of my best times in the markets. I love this kind of thing, but that is a very sad story right now. Vector candle recovery principle right there. Did you pay? My days. Did you pay yourselves? Oh, Bitcoin, no. Bitcoins, please come back to the vectors, but don't come back to the vectors. Please let yourselves take some money out of this game. Although Bitcoin isn't really doing much, they are starting to release information. Let's just have a look at what else is going on across the board. Dollar dominance, has it done it? Yeah, dollar dominance is gapped up. That's not a good sign, ladies and gentlemen. We don't want to see the sign of the dollar dominance moving back up because they are then running into safety. It's going. It's gone. It is gone. That's it. Bitcoin is done. Done. If it can't hold the daily open, it's finished. Bitcoin will keep going down lower, but we do have the press conference, so it might not be over just yet. But do you understand the importance of paying yourselves? Please get that in your minds. Right now, you can see the orders are coming in. We've just had a big delta hit to the downside. What did we say about the delta? Convincing the trader to step in and go long, and he's made him pay the price. Stick with it in your mind. When it rises, you do not go long. When it goes up, you will never buy anything that continuously increases in value. Never do that. You're mugging yourself. You sell at the highest point. Everyone running in for that Santa rally. Well, there's your Santa rally. Santa's just popped off his sleigh. Now look what's going on down at the bottom of the book map. Everyone's got the commitment. They are all now shaken out of their longs, and now they want to go short, and this is where the market will snap back up and eat that liquidity to initiate another reversal back down to finalize the wick in the chart. Look at the imbalance between the bids and the asks. Look at it. You'll see it very shortly. Look at it. It's all over the place. It should come up red and green. You can see down here, we've got the green right there, and we've got the red up there. There is huge imbalances right now. Sad days. Who's been liquidated? Let's just have a quick, whoa. Let's get back into it. Hold on a second. Big sell-off right there. Look at that. That is terrible, man. And they missed that. Look at that liquidity right there. $688 million worth of short liquidations did not get taken. And we still have the FOMC press conference. Let me slow it down for you guys. Man, I need to just take a break a second. Whew. Back up to the VWAP right there, ladies and gentlemen. There's your break. Okay, so now listen, on the 15-minute time frame, we have 10 more minutes until this candlestick finalizes, all right? What has been said? Chat, tell me what has been said. I do not want to take my eyes off the chart. What has the projection said? Please put in the comments. Please put in the comments. It's not over yet. We've still got power to speak in the next 25 minutes. Listen, I'm no fudder. I'm telling you what's happening in the charts. Remember that. I'm a day trader. Tomorrow, Bitcoin could be all the way down at 17.2 to test the psychological region itself. Does that mean Bitcoin is over? No. But all they're doing is recovering the vector candles. Short-term interest. Why? If everything is moving up before the meeting, is it because we already know what the meeting's going to say? Why do they do it? Because they know people are impatient. Fed officials see 0.5 GDP growth at the end of 2022, 0.5% at 2023, and 1.6 for 2024, 1.8 for 2025. 50's confirmed. We knew this. What's the rate of the median? Here we go. Chad Simon, thank you very much. Fed officials see Fed funds rate at medium of 4.4% at the end of 2022. Fed officials see the Fed funds rate at a rate of medium of 5.1% at 2023. Anything about the terminal rate? Then again, they haven't actually started to speak. Here we go. Jerome Powell and the Fed just raised the interest rate points. Yes, we're familiar with that. What we're looking for from Jerome tonight is we want to hear if there is a potential terminal rate. What point will they stop increasing the interest rates, because principally 50 basis points, all right, it's less than 75, but it's still increasing the interest rate. Where's the terminal rate? This is what we're looking for, ladies and gentlemen. Now, Bitcoin is currently back at the VWAP itself, which is pretty good. They've started to show a reaction right here. And as long as they can hold this point, then we're all good. But again, you see what I mean about the way they manipulate the charts. They trap traders. Now, all we need to be aware of, Bitcoin now is coming down to 17,984, not really making the move on TradingView. TradingView seems to be a little bit laggard. USDT coming back up as well. It's a sharp move up. I'm just waiting to see what Powell is going to say. Ladies and gentlemen, going over to USD JPY coming in, looking like it wants to come back into the vector candle region right here. As we said about gold comes back down into the vector candle region and it stalled. It didn't make the move. Now, that could be because TradingView might be a little bit laggard, and we kind of had the move right here on Atos platform, which is a free platform, ladies and gentlemen. Remember that. Let me just have a look at the Japanese yen. Where are my yen traders at? Here we go. Yen going down. Yep, they're picking up dollars, ladies and gentlemen. They're picking up the dollars. Bitcoin still coming down. Let's go over into that part. We are now still red vector candle, 7 more minutes until the vector candle finalizes, which will be 15 minutes until Powell actually speaks. That liquidity at the top side of 18,300, not really seeing it right now. Don't want to see it yet. I've got 287 Bitcoin at 17,800. There was a bag of liquidity down here, but they didn't manage to take that zone, which is pretty interesting given that we've got a lot more commitment coming in. They're actually starting to break down. Let me just zoom in closer to see the speed of these orders getting filled. Are we seeing this commitment? 291 Bitcoin at 17,900. If they pick that up, we see a little bit of a reaction. They've rejected the VWAP. Oh, big play right there. Big play right there. 134 Bitcoin orders picked up on that on the order book. Remember, anything behind this white line right here, ladies and gentlemen, this line on the right are orders coming in. On the left are orders that have been cancelled and placed. Here we go. Big sell-off happening right there. Remember, the book is imbalanced to sells. So we assumed that we're going to see price going back up. They only came back up afterwards, but now we've got 0.3%, not really seeing an imbalance in the order book. So everything seems to be working okay. But volume is aggressively to the downside. So just be mindful of that. Let me just go over to GBP USD. Oh my days. GBP USD, complete wipeout across the board. Euro USD coming down. Now, the FOMC state, or the press conference itself, if it's going to be designed at giving anyone any good information, the principle of the matter would say that everything else would now reverse back up and recover the vector candle in the region. Alternatively, from now until that principle, we would then anticipate them to try and finalize and move back up into the zone to eat the liquidity. But the problem I've got is if they leave a wick on the vector candle coming to the close of the 15-minute candle, then that would tell me that they could continue to break down lower. Okay, let's roll over to the S&P itself. Oh, my days. Oh, S&P. There we go. Back down into the vector regions, coming down to test into yesterday's low. We spoke about it yesterday. 3 distribution days, and volume wasn't as high as what we expected it to be on yesterday's CPI data. That is just a treacherous thing right there. Tesla is going to probably lead the party. There you go. Tesla is contributing to the move down to the downside on the S&P itself. Remember, when big stocks actually start to sell off, they start to follow suit. Bitcoin's going down to the 17,900 zone. Here we go. We've breached that point. We really need to see Bitcoin hold the daily open because this would be the last consolidation point inside of the chart, guys. So just be mindful if the FOMC does come out with anything that's going to surprise everyone. Oh, my days. Guys, listen, so sorry, man. I am so sorry about the way that I'm speaking right now. This is one of the most anticipated times during trading. Why? Because the Fed can just rock the markets in any way, shape, or form. And we do have a little bit of an edge by principle of the hybrid system. And if you are new to the channel, head over to the Traders Reality website. It's tradersreality.com, and you can download this free of charge, okay? Be sure to download it, get into the Discord, join the pattern watchers over there. You want more information, check out the Patreon.com/Traders Reality. It's pinned to the top of the chat. Now listen, all we need to be aware of is once Powell finishes talking, that will be it for FOMC until next year. So whatever he says from now or when he actually starts to speak, because he's going to be speaking for roughly about 10, 20 minutes or so, maybe half an hour, it's not over. When Powell stops talking, then you start trading. Now, if you guys have been trading and you've been taking longs, congratulations. If you've been paying yourself, even better. But if you just got liquidated, please take the lesson, learn from it, because they don't care. Look at this. Just look at that right there, down at the lows on the book map. Did you just see that order? You didn't see that order coming in, but we've just got a big order coming in right there, ladies and gentlemen. This is a big move now. They're holding that VWAP, doing a very good job of holding the VWAP. This is a key point right now. 10 past 7, still not got the start of the new vector cam. Hold on. 4 minutes. Yeah, 4 minutes until they start. Let me just bring up this bad boy over here just to have a look. Right, so look, this is what's going on here. Look at this imbalance right here. They come back and refilled the imbalance. But look, buys, 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 buys. Look where they sold from. They sold from the highest point, but then they allowed retail to step in. Notice the difference in volume between these areas here where they're actually trapping traders, and go to the lowest point where you see the big, thicker volumes. Look at that. Look at that bad boy right there. Yeah? You want big volumes coming in. You don't want these small ones. These are traps. Look at the imbalances. Now, naturally, we would expect Bitcoin to try and come back up into this. We go into the higher time frames itself. We just go to the 4-hour time frame. Look at how close they were to that liquidity zone, man. Violet vector candle, ladies and gentlemen, on the 4-hour time frame. It could mean that if Powell says something good, then we would see a nice recovery of this bad boy. In its 47 minutes time, they will be starting a new 4-hour candle. Going to the higher time frames itself, any vector candles, nothing. Rejection at the 200 EMA, stop hunt rise and rip back down again. 10-hour time frame itself, we got 47 minutes. Blue vector candle right there, and that's a cause for concern because we know what that means on a blue vector. We know that they like to recover these blue vectors. Go back in the charts and look at any blue vector candle, and you will see that they have this habit of recovering the blue vectors. One zone right there, you got a recovery zone right here, and then of course you got the violet vector and the blue vector right there. Another blue vector candle. Put the math together, ladies and gentlemen, and use only a certain amount of liquidity that will allow you to give you the chance to sit through any drawdowns or any trickery of the market like this. Okay? Going into 11-hour time frame, look, it's stop hunt, back down, blue vector again. 12-hour time frame, nothing for us. There it is, 13-hour time frame, nothing. 14-hour time frame, small price action. Could they go and trade negatively on that? Going to the 15-hour time frame itself, coming over into the last gains of the last move, the last 15 hours. 17-hour time frame, what have we got? Green vector candle down at the lows. 18-hour time frame, Powell's going to wreck the party, man, I'm telling you. He's got the recovery already of the blue vector in the zone on the 19-hour chart itself. Keep going on to the 19. We've got a blue vector candle again. Daily time frame itself still holding out on the daily, so that's a good sign. We've tried to break the 50 and no follow through. 200, the VWAP itself on the BookMap showing commitment coming in right now, so we just need to sit tight and wait for Powell to have his business and conversate on what they think they're going to be doing with the marketplace. Oh, my days. Ladies and gentlemen, how many of you, I want to ask you all, just before Powell starts speaking, how many of you, and be honest, how many of you kind of got any stops hit or any liquidation points taken? Has anybody's liquidation points come out? Did anyone get hit? Went 8K, bro. Symmetry, don't worry, bro. I see your comments. I see your comments, bro. Don't worry. Yes, we know the Fed is going to increase rate hikes, but if he tells us where the terminal rate is, the market will shoot up because they will price it in. But we don't know. We just know that they're going to keep on increasing the interest rates, ladies and gentlemen. The daily open has to hold to show us that there is commitment and that they are going to hold out and absorb what Powell says and project that the economy, or should I say from now until the end of the year, they're going to try and pump everything up. We're waiting for commitment. Who do you think's going to win? That's the question. Who do you think's going to win? Let me just go back into Euro USD, we're coming back away from the wick. I don't like that idea because we've had more volume. Here we go, new 15-minute candle right there. This is the moment of truth. Is it going to come back up, recover 50% of that candlestick, get your Fibonacci's? I only use Fibonacci to find half the zone itself, and we would expect them to try and recover 50% of that candlestick right there. USD CAD and USD Swiss moving up swiftly. USD CAD up there. That means oil's going down. Tesla is still continuing the move to the downside. 50 more minutes until Powell talks. Dixie coming back up. That's a huge gap, which dollar will actually come back to, okay? But it's all about what it does now. That's the key thing. Dixie is moving up strong. It is moving up strong. The volatility index, actually, let me just have a look at what's going on with gold. Gold is still going down, ladies and gentlemen, and we've got the NASDAQ itself. Here we go, NASDAQ coming into that zone, coming into previous vector candle. Look, it's closed the gap right there. Ideally, we want to see NASDAQ, realistically, we want to see NASDAQ try and contain price inside of this zone right here. I'm allowing NASDAQ some room to come down towards this point to bounce back. Ideally is what we want to see that. But it's whether or not the Fed gives us that flavor. The yields are actually starting to come back down, but they did gap up aggressively. The 10-year bond still looking like it's coming down. Remember, this is the cause for concern. This area here, that is what I'm looking at. This bad boy. We want to be mindful of this zone. And if he does say anything, oh my days. You really want a dovish stance. We don't want the hawkish stance. S&P's trying to come back up, guys. Google, coming down into the gap right there. Some Chinese stocks getting ready to close a gap down here as well. Where's NEO? Let's have a look at NEO for a second. Getting ready. We need to close these gaps off. And even if Powell does have the conversation, Bitcoin's coming close down towards that daily open, man. Come on, 43 minutes. Let me go into the other vector candle region itself. Let's go to the 15-minute time frame. Where we at is stalling. We're waiting for Powell to speak. 40-minute time frame. We're going into that zone. See him trading below the VWAP itself. The longer they stay beyond the VWAP itself, the more likely they're going to start coming down in towards these zones. 17,400 is where we would absorb at least 2, 4, 6, 7, 9, 10, 12, 4. So about 2,000 Bitcoin orders just inside of this zone if it stays static. But we've got a commitment down here which keeps on increasing. 359 Bitcoin at 17,800 coming back up to the VWAP itself. What have we got? Quarter past. It's still taking forever for this to actually come in. Let's have a look at Ethereum. Poor Ethereum, straight back down. Nice, beautiful M formation right there, ladies and gentlemen. We like these M formations right here. We do like a good little M. Going into Euro, still forming that zone right there. GBP Yen, a crazy ass thing. I'm sorry, forgive me for that. Let me just go over to Exo charts and dive in deep. Look at the delta right there. Now, when the delta starts to come in like this, ladies and gentlemen, it could be make or break. Look, are they picking up longs or are they picking up shorts and closing off their existing positions? Because this could be the start of the move even lower if Powell does give us the wrong reason, okay? 34-hour candle right here is still trading stronger to the downside. Let me just go closer into this order book just to have an understanding of where we are. Lots of commitment coming into this point right here. This zone right here would be the point of support inside of this candle. So we just mark it off right there just so that we're aware of it. Happy days. Powell speaking very shortly, guys. How many of you in the live stream? 2,335 of you. Mad love and respect. How many likes have we got? 600 likes. That's exactly the perfect ratio. There is clearly an imbalance in the likes to viewership. Let's get that likes ratio up, ladies and gentlemen, and work towards that 100,000 subscriber list. Man, 100K, ladies and gentlemen, man, that is crazy. Mad love and respect to all of you passing through and showing love to the Traders Reality and the pattern watchers in and around the, what do they call it? The interwebs. Happy days, man. It's all about the interwebs. Anyways, let's go back into some price. I mean, keep an eye on Bitcoin coming down slowly. Looks like it wants to break down. Let's go into the smaller time frames. Just look what's going on. Okay? Can you see what's happening here? Green vector candle gets fully recovered as well. This is a stop start. They come down, trap the retail trader to the shorts, to the downside, hit his liquidation points for his longs, make him believe it's time to go short. He goes short, he shakes him out, holds it at the daily open. Now we're waiting to see if they can sustain this. Powell will be speaking very shortly, guys. I hope you're enjoying yourselves. Please tell me, are you enjoying yourselves? Are you Mike, Mr. Dutch? Are you in the room in here? Who's in here? 100K at the end of year. Happy days, Mr. Mitch. 100K at the end of year, man. What's this guy? Look, do I want Bitcoin to go to 100K? I want Bitcoin to go to 1 million. I want it to go to as much as it physically can. My goal on this channel, whether I say it in an explosive way, if I'm excited, if I'm crazy about it, I'm trying to get you to understand that there's two sides of the story. You become biased to one way, then that's where you're going to start getting emotional. If I keep talking bearish, well, because everything's going down. I'm only going to be thinking that everyone is bearish, where I'm looking for opportunities to long on the smaller time frames. That's my strategy, ladies and gentlemen. But for the bigger picture, the person that's looking at the charts on the higher time frame, would he be in agreement that the actual bottom is in? Is it in? Can we believe it's in or not? No. I don't think the bottom is in. That's it. And if I don't think it is, I'm going to look to see what else I can do and exploit that. Give me a reason to believe otherwise, and then we'll start talking about price going up and some of the world's greatest stock traders. And you'll see them on Twitter. They will all say they never made a career on bottom fishing. Those guys are the guys that like to do this. They look at the charts themselves, hypothetically, and they see that if Bitcoin like this has been moving up, and let's say it's been moving up for a sustained period of time, these guys are all out, and they are happy with trying to grab the last 10% of a move. Happy days. You got guys that may have caught the 10% of this move from the lows down here all the way up. If you manage to catch at least 10 or 20% of the move, congratulate yourself, take the dog out for a walk, buy the missus a handbag and go get yourself a coffee. That's all you need to do. And then guess what? Come back tomorrow and rinse and repeat if you can, if the opportunity presents itself. All right, then here we go. So what have we got? 10 more minutes until Powell starts talking. He's going to get the business. He's going to start doing his hands in his arms. He's going to be looking up. He's going to be doing all this stuff with his face. Any psychologists in the stream, let's pay attention to whether he looks left or he looks right. Isn't it, if you start looking right, you're trying to actually pull out information that you already have, and you're going to try and be creative with it, and then to the left of it, you're trying to think of something to say and lie. So keep an eye out on Powell when the camera's faced on him, okay? And if they've got the camera at an angle, it's because they know that people are actually watching that kind of thing. I'm going to see if he's lying or not to try and exploit the charts. So that's another story, but anyway. Okay, then, cool. Look, we're going back into this area where the delta was quite strong and they were picking up orders. So the longs are being tested right now inside of this zone right here. Keep an eye out on this. Keep an eye out. It's starting to get a little bit interesting. They still haven't violated that VWAP, man. Why are you not taking the VWAP? Big orders coming in, 367 Bitcoin, 17,940. We've got 626 Bitcoin at 17,600. Why do I tell you these? I'm not reading them because it just sounds really cool to read it, because I can read it at the speed of light. But what I'm trying to get you to understand is the commitment that's coming in. And the longer we keep seeing the commitment up there, you've got 18,319 Bitcoin orders. Look, they're getting busy right now, man. They're getting busy. Powell's going to start speaking very soon. 324 is starting to get some movement. Look, we are right now at the session volume profile right here. We are smack in the median. We are in the happy zone. The VWAP is right there. Well, sorry, VWAP is right there, and it doesn't look like they're coming close towards it yet. If we zoom out on the BookMap itself, we know that there's been a ton load of short liquidations that have been hit, and now they're slowly, I mean, look at this, man, 463 Bitcoin at 17.6. Can they actually go down to 17.36? Sorry, 17,600. If they can't hold this area here on the 4-hour time frame, then that's it. It will look like it's going to go lower, but just look at the way price is moving up and down. If you're a leverage trader and you're using 100x, you want to stay away from these environments because you're going to get shaken out, and you're going to be giving the liquidity to Mr. Market Maker who knows people are running for shorts right now because he got them trapped on the longs. Okay, look, now we're going into imbalance. Look, this is a huge imbalance. 0, 0, 0, 0, 0. Happy days. We want to see them finalize this. The sooner they finalize this, the more of a chance that we have seeing price trying to come back up. So for my day traders, if you're looking for a chance to exploit price, drop down to the 1 minute time frame. 1 minute time frame is treacherous, but 1 minute time frame is where the business develops. They tell you not to trade the smaller time frame, but the market makers have algorithms that operate off the smaller time frames. Okay? Pay attention to them, because the moves don't just happen in one candle. It happens in a collection of candles. If you're looking at the daily time frame, you're going to miss the move. You're looking on the hourly, you're going to miss the move. You're looking on the 1 minute time frame, you're going to understand the frequencies of how price goes up and down, and then you're going to say, okay, look, we keep on going up, and then we keep closing lower as we go higher, which would suggest to me that the development of the candle is going to lead price even higher. That's how you project the idea of price. Now we've got a test of the daily open. There's clearly interest at the daily open. We would expect price to come down to the daily open to test the narrative. We are 5 minutes into Powell speaking, ladies and gentlemen. Just pay attention. If he does say something optimistic for the market and they've dropped price to only bring it back up, you'll start seeing green vector candles appearing at the low. So if you do have the hybrid system, make sure you are aware of that. We want to see them test the daily open. If they can't hold the daily open, it's yippee-ki-yay to the downside, ladies and gentlemen. And it's now going to start getting even busier when Powell starts to speak. Here we go, coming into the recovery of the wick right there. It looks like he wants to try and take that zone. They need to finalize this imbalance down in the charts, man. Let me just go over to dollar itself. Let's see how dollar is doing. Dollar, where you at? Here we go. Dollar's still holding, hasn't broken up high yet, which is pretty decent. And we've got big red vector candles coming into this zone right here. So we've got to be very cautious with dollar, because they could come back up if they don't like what they're hearing, and if he does maintain the hawkish stance. NASDAQ itself, where you at, coming close towards a negative reading. We've got S&P trading negative for the day, which is going to be consistent with the NASDAQ, as it will probably do the same thing. We need to see them. Oh my God. Oh my days. Forgive me. Forgive me, I'm just waiting for it. I am waiting for this madness to unfold. Sorry, guys, but I am just pumped right now. I am pumped. Need to take, no, that wouldn't be a professional thing to do. No, we will not do that. Okay, here we go. 5 more minutes. 5 more. I am you're my father. Happy days, man. Happy days. You got heartburn, bro. Listen, I recorded a podcast last night. A remake of a podcast with my guy, Jason Casper. Jason Casper, we did a podcast together. Mad love to my guy. And guys,
My name is Michael Edward, former award-winning hedge fund trader and now the current head trader for True Trading Group, the fastest growing and highest rated trading educational community that exists to help you learn, trade, and profit. 6 days a week, Sunday through Friday, we go live on the True Trading Group.
Point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure.
Car washes are a beautiful thing. You get to experience each step in an automated process. In our businesses, we have processes just like this, and if you want your business to run as perfectly as it could, check out Trainual to document the processes in your business.
2.1% in 2025. Give confidence that inflation. Participants continue to see risks to inflation as weighted to the upside. Price pressures remain evident across. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation, and we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up. And it could move down if inflation data are softer.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. And that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services, and that's really a function of the labor market largely. The biggest cost by far in that sector is labor, and we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. 0.5 percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there, far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, state of the economy, the state of financial conditions. No, absolutely not. No, as a just.
Are you three together? There are no girls at the table.
Reflects any data that comes out during the meeting, and participants know that they know this, that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
In order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You know, you can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand